and share what you see from how did we get here and where are we going?
It's been a wild ride. So, as long as I keep having guidance from Yogi Berra and Jimmy Buffett, I think I'll figure it all out because they're my two favorite economists or whatever. So, yeah, it all started with the Fed and it's all going to end with the Fed. So they were, the transitory, right? They're going to be right about transitory something. And I think it's transitory from a good economy to a recession, but let's hope not. So that's how we got there. You want me to just kind of jump in, or do you have questions?
Jump in with the program. You're the expert. They come here to see UKC, and I'm always loving and just listening to everything or your wisdom and obviously your knowledge of going through many cycles. Right, is so important.
Yeah, I appreciate it. It's always an honor to be here with you. So I thought I'd put our report card up there, Jim, on how well we did, on our last call and forecasting where we were headed. And look, we said four things. We said it's a challenging period. It's going to be ahead at the end of last year. And we were exactly right. We said office is going to be the big problem and pensions are already starting to sell the buildings and it's getting worse. We said, multifamily will stay strong. It's not going to go unscathed, but as long as the Fed keeps buying mortgage-backed securities on the balance sheet and Freddie and Fannie staying in business, I think we'll be okay. But the single family is a different story. And there'll be no soft landing. I don't see a soft landing. I see this as a really, really tough year. So congratulations, Jim. You were brilliant. You inspired me to give right advice. So I've kind of declared my theme here for us today is it's kind of like a deja vu economy all over again. Yogi Berra, he's just a classic. And, here we're facing a debt limit ceiling here this next week. So even though we have the government supposedly funded till next September, we can't spend the money because we can't go over the debt limit. We have Janet Yellen, telling us, oh, the house is going to burn down when she said, no, it wasn't going to burn down. Anyway, January 19th is going to be a really critical day. Where we get to this thing is, if you want a real piece of history, the 1884 Anti-Deficiency Act says you can't spend more than you don't have. Americans and businesses, we get it, but our government doesn't. I put a little chart here to show you the history of shutdowns and disruptions. And, it's kind of equal between Republican and Democratic presidents. And they keep lasting longer and they keep getting worse because we keep going more and more into debt. So the $34.1 trillion ceiling is going to be met here in the next week. And we'll see what happens. So that's the deja vu. So here's what I think we really need to watch. I've had some of these up before, but I simplified it to just 5. So the Federal Reserve, I got a little graphic here I'm going to spend a minute on. The 4 key inflation metrics. So PPI, the producer price index, that's what all the people that make things, that's what they have to deal with. And they got to pass it on in the CPI. So what's happening in the PPI is kind of foretell what's going to happen in the CPI. The CPI, we're going to forget the terms of core and non-core, and we're going to add a new one, Jim. It's going to be called supercore. Supercore is inflation from services and wages. Forget everything else. Those are the 2 things that we can't get under control. The flexible CPI, my friend Jim Bullard at the St. Louis Fed, this is what you and I, our own household, this is what we spend money on. It's come down because energy prices came down, but when those unwind here pretty quickly after the SPR reserve, then we're going to have trouble. The confidence measures, you can see that nice hot air balloon that just got hit by some kid shooting an arrow from the Federal Reserve. It's deflating the economy. Consumer, small business, housing, we're all miserable. We're all very down on our confidence. And then I'll talk about the crappy in a minute. So let's look at these 5 in a little detail and feel free to interrupt or interject here, Jim. So this was a great chart that was done that shows the trajectory of Fed rate hikes going back over history. And the one we've just been through in literally the last, 8-9 months is the steepest we've ever seen. Going back, it beats out 1980, beats out 2004 housing collapse. You can't just do this and then in a compressed period of time without really hurting every single industry in the economy. It's not just ours in real estate, but from real estate, it hurts our tenants. It hurts our businesses that are our tenants in our buildings. It hits housing. It hits construction. It hits all of these things. So this is a really good graphic to visualize that. Here are the inflation metrics. So these are the 4. On the upper left is the PPI. This is the one that feeds the into the CPI. But in that upper left quadrant, I've got a second arrow there that's highlighted in yellow, a 19% rise in producer prices for construction. this is shutting down anybody thinking about building something or whatnot. While we're getting some relief, this was the big mover in the PPI that anybody that's building, what the builders are having trouble with. This is why they're seeing a lot of cancellation rates. Some public builders are seeing over 60% cancellation rates. That's pretty tough. Over in the right there, there's the CPI. I told you we're going to forget core and non-core. We're going to go to super core. That's wages and services. Those are the double-digit increases. And if we get energy back in the game, which I think we will, energy, we didn't have the strategic petroleum reserve in the first and second quarter. That's why GDP was negative last year. Then we released the strategic petroleum reserve. We brought energy prices way down for the third quarter and into the fourth quarter. That ends here. And so when those prices and those price subsidies and that supply goes away, I think we're going to see the energy inflation come back and the CPI look a lot different. PCE in the lower left corner is what the Fed looks at. This is personal consumption expenditures. This is what they want to look at. What are consumers, the individual consumers, where are they spending money on? The next release comes here January 27th. It moderated. You see there in November, which was their January release. And the main reason was energy. So energy prices came down, that personal consumption expenditure can come down so we could go spend money with Santa Claus at the North Pole, and we did. And then over there on the right is the flexible CPI, which is by the St. Louis Fed. It showed actually a drop. We saw last year, mid last year, it was up over 20%. That's the real household inflation for consumers. That's what we were experiencing before the SPR reserve. Now it's about minus 5%. That's all because of energy. So that's the inflation story. Here's a way to look at it on how it really affects us individually and regionally. This is Forbes did this one on gas prices across the country. And you can see on the West Coast, they're really hit hard, even though they've come down. They're still in a $4.50 to $5 a gallon. But in the Southeast and South, where I spend more of my time, we're at, $2.85 to $3.35. I just filled my car up under $3 a gallon the other day. And I thought, is something wrong? Did I only put a half a tank in? What's going on here? But this is how the bifurcation of what's going on with inflation is going to play out. Wages are different by region. Energy prices are different by region. Electric and utility companies and their electric rates are different by region. So this inflation story is going to feel a lot like maybe the oil patch. Early in my career, some regions that were dependent on energy and oil, like Houston and Colorado and Oklahoma, got destroyed. I was sitting here in Georgia and I didn't know what an oil patch was. Never seen one, even though I grew up in Colorado. So this kind of helps visualize this inflation story. Is it uniform? It's not felt at the same level by individuals or geographies. Here's the big one. Inflation, recessions, recoveries, they're all psychologically based. We all have not found our good medicines to get out of this mess. It's about confidence. And right now, the consumers and the businesses and housing are all just terrible in confidence and don't want to spend money. They don't want to continue to hire. They'll hold on to their hirings. So in the upper left, you can see the University of Michigan. It's the longest one we've got going. You can see that the lows, we hit 50 in June of last year. That was a record low. We bounced back up a little bit to 55.3 here, 56.8. These are still terrible numbers. These are just horrific, as you can see historically. And again, the only bit of confidence we got was, well, maybe energy prices are coming down, but most people didn't connect the dots to the Strategic Petroleum Reserve. Over there on the upper right is the National Federation of Independent Businesses, is small businesses. And we really need to pay attention to them because these are the tenants that fill up our shopping centers, our office buildings. These are our multi-tenant small business companies that run in almost 2/3 of our country. And what the NFIB is telling us is that in December, it marked the 12th consecutive month where the small business optimism has been below the 49-year average. So this is not a little blip. This is not a mild recession you keep hearing the media people talk about. This is very severe. And then down there in the bottom right is the NHAB Wells Fargo housing market index. And there's no other way to say it. It's in the toilet and somebody keeps flushing it and we can't get them out. The numbers are terrible. And we're starting to see a real serious problem, which are builder cancellation rates. You look at an entity like KB Homes that has said, they're looking at a 60 to 65% cancellation rate because as the person that put the house under contract, they go back to re-underwrite it. The bank says, no, you don't have enough money, or the price went up and they can't afford to do it. So these confidence measures are very important. Here's the misery index. Yes, if you're feeling miserable, you should. This was created by Steve Forbes in the Jimmy Carter era. He's refreshed it to the new misery index, which includes the stock market and GDP. and it's not pretty. So you can kind of see by administration, and we're on an upward trajectory. There's another one about, Jim, the CCIM Institute. A little over a year ago, I was involved with CCIM Tech in developing this CREPI index, which is a very forward-looking measure of the economy and real estate. So what we did is we picked just 10 metrics. You can see them at the top there, from University of Michigan down to the number 10 Green Street Commercial Property Index. These are not overweighted in one sector like housing or jobs. It's across the board. We put an algorithm together and we back tested it, back to the last century. And we found that the index was pretty accurate. We didn't miss a downturn or an upward turn by more than one quarter. And so we saw it staying up pretty well at the beginning of the year going into this year. And people say, well, why didn't you get it early, Casey? And I write a narrative, which is right here. And the reason that we didn't get it is the Fed didn't start rate hikes until March. They knew they should have raised in January. They knew they should have risen last year. And then they didn't do it in January. They took a break in February for Groundhog Day. Then they came back in March and they said, okay, we'll throw a token quarter point out. Then they took another break for spring break, didn't have a meeting in April. They came back in May and they had an expletive and said, oh my God, we got to start raising rates. They went 50 followed by 475 basis increase. And so that's why those rate increases didn't filter into some of these numbers. What I'm forecasting right now going into the year is that our biggest things we need to watch are these elevated job cut announcements. We see it from Challenger Gray. We saw over 80,000 tech jobs cut, and that's 24 million square feet of office space not needed by those cuts. And then the capital sources. This is our biggest problem. The Fed is basically told banks, lending is a growth. It's inflationary, so quit doing it. So the banks are locking it down. They don't care whether you're a business. They don't care whether you're a home builder. They don't care whether you're a loan that's rolling over. They just are shutting everything down. And that is our biggest problem. Our industry is very dependent on capital. And if we don't get the Fed to understand and connect that dot, we're in real serious trouble here. So I don't know if you want to pause there, because then I'm going to go into the real estate stuff. I don't know if you have any thoughts or comments about the economy, Jim.
Casey, and it's so interesting because we remember, right? Sometimes our memories are short when they should be long, and how they change, right? When you have technically two negative GDPs is a recession, and we had it. So how can we adjust and change the way we measure, right, the economy and just change it? I mean, I'm just curious.
That's what government and politicians do. And so if you think about it, the Biden administration, and the Republicans would do this too, so I'm not trying to be political, but they knew in the summer their numbers were terrible. Some things had gone bad the first part of the year. They said, man, we're going to lose the election in all houses of government if we don't do something. So they said, you know what, let's get energy prices down. Let's release all of our oil out of the Strategic Petroleum Reserve and hope nothing bad ever happens. And that's what they did. And they literally brought gasoline and diesel prices way, way down. That affected the energy component in inflation. It looked like everybody says, oh, inflation peaked in June and it's come down since. It's a gimmick. And that's what politicians do, is they figure out the gimmicks to get your votes, especially in election years. And unfortunately, the media doesn't always dig deep. We don't have EXP TV yet, right? We're going to get your own network, Jim. I'm pushing for it. Instead of, we're going to replace CNBC and Bloomberg with EXPberg or whatever. They don't go deep on this stuff, and they don't connect these dots. I couldn't find a single story that connected the dots between energy prices, inflation, and the Strategic Petroleum Reserve. I did a review, couldn't find one of them. So they all go along with it. But that's how we do it. We come up with gimmicks. That's what we do in America today in our markets. It's all short-term thinking, not long-term, and put gimmicks. And you're exactly right. If we don't have people like you and your company out there helping us connect these dots, the dots don't get connected and we get slaughtered. So thank you for letting us not be slaughtered.
Well, thank you for sharing. And, we'll see who gets the biggest barbecue sauce later. But one final thing, now that, we will say that elections, right, since it is political going to 2024 in 2023, right now, all kind of bets are off to a certain extent, right? We were waiting for the midterms. And I think you're going to share and show everyone, what you're kind of seeing for the forecast of this year, but things that led us up to it. But Casey, thank you.
Yep. Sure. So we'll look at commercial real estate. That's what we do, is real estate. So I put up here, the Green Street Commercial Property Price Index. It's more institutional, higher quality. So if it's in trouble, everything downstream is in trouble. You can look at RCA. You can look at others out there that have their index. But here's Green Street, and it showed, as we said, at the end of last year, the values had peaked. What was happening was expenses were growing faster than rent. And so if you have that, you have your NOI take a hit. And even if you have the same cap rate, the value is going to decline. So we saw that start last year, at the end of the year, about 10, 15% decline. It's accelerating now, and it's going to accelerate because as people have to refinance or try to finance assets that now are at, double the rates what they were at the beginning of last year, then we have maturity risk, we have loan defaults, we have capital lockup. So you can see a couple of things that are interesting here. So in the upper left there, I have a red arrow to lodging. And so there's a new term, Jim. We're going to be really fashionable. We're going to teach everybody the new hip terminology today. It's called boo leisure. And this is like you and I, when we travel for work, we've got to squeeze in an extra half day of relaxation, or we stay over an extra night. This is the business traveler saying, you know what, I can work remote anywhere. I'm going to squeeze in an extra day of leisure because I'm not going to the office. I can do that. So business hotels that are in places that are close to work or we have a good enjoyment thing, they're doing really, really well. And who would have thought that? Because lodging is usually the first thing to go in the toilet in a recession. And this may be the first time ever that lodging doesn't, and it outperforms everybody. You can see in the lower left there, apartment, look at that. The values of the last 12 months are down 20%. Here's the good news. Apartments can absorb it. They had a lot of fat on the bone. They had thick, rent increases that have contracted smaller rent increases, but they're not decreasing. And then our old friend, the malls and retail, are still pretty bad. We're still seeing the uptick of announcements by store closings. We have had a bunch of those here in January, which is what we've been doing every January for the last 10 years as we've gone through the retail apocalypse. It's still with us. And so you can just kind of see that chart. Now, the one I want you to pay attention to are these next slides, 14 in particular. This is what we have, unfortunately, to look forward to. This is what happens when we look at the impact on value from the increase of debt costs and the cap rate. So the cap rate, when we have transactions lock up, appraisers go to this thing called a band of investment. We mathematically calculate what the cap rate should be based on the cost of our debt and our equity capital. It's pretty reliable if you do it right. And so here on the left, I've got kind of it broken through. And what this means is with the increases we've had, the 7 increases we've had, what that should mean is that the cap rate should have increased from, say, something in the 5.5 to 5 3/4 range a year ago to over 7%. That translates same NOI to a 25% decline in value. So if we've had 10 to 15 from expenses outgrowing revenue, and you put 25 on top of that because of the cap rate changing from the cost of debt, that's how we get a 40% decline in value. I fear that's what's ahead if the Fed doesn't figure it out really, really quickly here. And I don't think they will. I think February 1, they're going to raise another 50 basis points. They may then at their next meeting slow, maybe to a quarter when they see the demand destruction, but they may stay on a 50, but they're not coming back down. Anybody thinks the Fed's cutting rates this year? You're crazy. Jim, you and I will get together and we will start marketing oceanfront property in Las Vegas, and anybody that's on that bet there. So this kind of shows you how that happens. And the other thing to look at is what's happening that drives this cap rate. When you calculate your mortgage constant, you have to look at what the bank's doing in LTV and debt service coverage and all of that. And they've cut the LTV from, say, 70% range to sometimes now we're seeing it only in the 50% range. So when you filter all those things through, even if the 10-year treasury is staying below 4%, that's why this cap rate continues to rise. It's not just the 10-year treasury. So this is my fear. Capital's locked up in the cap rate increases that are coming because of the increased cost of capital or what's ahead of us. All right, you ready for a little good news? We'll play the good news here. I get my favorite Christmas gift in early January, and it's the moving reports by U-Haul and United Van Lines. Now, I will tell you, do not read the United Van Lines. It is barbecue sauce, Jim. They said that the states where people most moved, the top 10, did not include Texas or Florida. Can you believe that? And they said it was places like Delaware and Rhode Island. I don't know who they were talking to or whether they were trying to sell Joe Biden another Corvette, but it's just plain barbecue sauce. The one that really consistently makes sense is the U-Haul. Now put at the bottom there, you can see Texas and Florida are always doing that for 1 and 2. That makes sense. Look at the strength of the South, the Carolinas, all the way down to Tennessee. And then look at the Intermountain region like Utah and Colorado. And then in the Midwest, places like Ohio are incredibly strong. And I'll show you a slide at the end that will do that. So really, where can workforce and business outrun inflation, afford to live and attract workforce? This is it. And U-Haul's got it exactly right. So this is one where if you've got 7 to 8%, job growth, workforce population growth, you can afford to deal with 7% inflation. So this is good news. This is another one that was interesting. It was done on where are all the wealthy millennials, all those that work for 90 days and they got a bonus, they got a signing bonus and then they quit and they go get another one and they make a lot of money and they just, even though they get laid off by, Challenger Gray telling us they keep making money. Where are they all moving? Texas and Florida. And then you got a few places in the Intermountain region. So this kind of reaffirms, where you'll be cushioned a little bit. All right, office. If you own an office building, it's going to be a rough ride. If you don't, please don't buy one, right? This is going to be tough. So one of my favorite metrics that I've followed for a long time is the Castle Systems Back to Work Barometer. That's the company that created our key cards that we use to get in and out of buildings and places. And so they tracked it in COVID. It went down like below 20%. But at the fall of last year, we were getting back into the 45% range. 45, almost 50% of us were going back to work. The most was in Texas, over 50%. Look at what's happened here in the first week of January. It's gone to bleep. We're down in the 33% range. There's no one in Texas that has even half their people going back to work. And so this is reinforcing that this remote work model, it's here to stay. This is as systemic as when the GIs came back from World War II and said, we're going to live someplace different. We're going to create this thing called a suburb and a regional mall, and that's going to drive everything for the next 3 or 4 decades. This is what's going on, and it's really bad in urban CBD, big markets, New York, Seattle, San Francisco. And it's less bad in the secondary markets because the workforce can afford to live. They can get a good paying 6-figure tech job and they can live close to mom and dad inland or, in Tennessee or Alabama, Georgia, Tucson, Arizona. They can get a great airport out of Phoenix or, Colorado Springs or Huntsville and they can make that money and not afford the expenses. So the suburban office is actually doing really well. So, and companies are even looking at how they do that. One of the top ones they're doing is branch banks, and they're looking at where closed branch banks are in proximity to their workforce, and they're leasing it and buying them like mad. So if you drive by a branch bank that's closed, think suburban office. That could be a really good play there. All right. Here's one that I think is also interesting for us to look at. I started looking with all this EV stuff and ESG and all the announcements, whether it's been Hyundai or SK Batteries or VinFast out of Vietnam or Toyota or Mercedes, where are they building, even Ford and GM, where are they building their new EV plants? And this graphic by Argonne, working with the Department of Energy, shows where it is. So if you really look at the upper Great Lakes, Michigan on down into Alabama, Tennessee, and Georgia, this is where the EV plants are being built. And they're also in Texas down into Mexico. And so this is what's driving. This is where we're going to see it. Look at Ford's doing its Blue Oval City in Memphis. You've got Toyota's doubled back into North Carolina to do its North American EV battery plant. You got SK Batteries all along the I-85 corridor from North Carolina down to Montgomery, Alabama. Hyundai's made 3 plant announcements. You got Rivian in Georgia. It's absolutely amazing. So I think this is a great opportunity for when we understand this, and then think of all the vendors that are going to come, and then where are all these EV batteries? They got to go into a car that's being manufactured nearby. So this is the battery plants, and they got to be in proximity to the automobile assembly. So when's the last time you saw something that said, hey, from the Great Lakes, the Midwest, Michigan, Ohio, all the way down to the South is just absolutely going to boom. So I thought this was kind of a neat one to share with you. So with that, I'll stop and see, where we want to kind of backtrack on some of these things or what kind of questions that we've got, because, I could put 20 more slides in here to what my outlook is for 2023 that are pretty negative. I think this is maybe the worst year that I've seen in my professional career. I started mine in 1985, and that was the beginning of the oil patch. And I grew up in Colorado and worked with companies like the Legacy Equitable Real Estate to have to go work out the properties in the oil patch from Denver and Oklahoma City and Dallas and Houston. And, I've lived through a few more, and I was at the Fed 2005 to 10 during the great housing recession, where where our Fed and our bank regulators, they don't connect the dots. They're largely academic. They've never made a loan, broke a loan, or fixed a loan. So they don't, but they're writing policy about loans and whatnot. So I'll stop there and see if we want to banter around on any of these things or take some questions, Jim.
Yeah. So Casey, on this, I love this map. This is very telling because, EXP, we're a global company, and North America, I love this. And then we're talking about Bank of Japan, right? Making that pivot. We're waiting to see what they're going to do because they're feeling too much pain, like other global or other countries' central banks. Where do you see it going? Because they may cry uncle before we do, and we've seen our currency drop, and gold prices moving up. What do you see kind of on a very global macro level with all these changes? And let's just say the Bank of Japan to start.
Yeah, so really interesting question there, especially on currency and where you move assets and where do you chase workforce and where you deploy capital. So as you know, the end of last year and through most of last year, our dollar strengthened. And that kind of made no sense to me because I said, we're a bad credit. we're like, kids at college that got that first credit card and they ran it all up, buying everybody pizza because they had a $10,000 line of credit and they had no ability to pay. But who's the idiot that gave them the line of credit? Well, we saw all this inflow of capital competing for the dollar, making the dollar go up. And the main reason was because the rest of the world we're a dollar denominated global economy, and we have to hold dollars to buy assets. Look at oil. Oil's priced in dollars. And if anything ever happens to the dollar, who knows what happens to the cost of energy and oil for us here. What the rest of the world hasn't fully appreciated yet is that even though we're paying a higher rate, so look at, we're up there paying, 4.25, 4.5 on a 2-year. We went above 4% for a while. So if you're in the rest of the world, and Europe and Germany are paying you 2% or less on your assets, but you can get a dollar denominated or U.S. Treasury 2-year or short term, and you can get double that. Where do you put your dollars? Where do you put your capital? Those are exactly the places that you put it. So we paid a higher return. We have everything priced in our dollar, so it's making our manufacturing more expensive to send to the rest of them. Theirs gets cheaper to go here. And if they want to save the value of that plant or that capital that they're putting to work here, you put it in the US. What they didn't realize, we have no ability to pay those returns. We're never going to be able to keep up and pay the 4% return on 2-year treasuries. And when they realize that, they're going to cut our credit off and the dollar is going to go down pretty seriously. So what is going to be the backfill currency for that? That's the unknown that we face. And when we look at the $31 trillion and going over our deficit, and whether you're a Republican or a Democrat, all you do is raise the debt ceiling, do another spending bill and pass the buck down the road. We're on a very dangerous trajectory here. And that's the one thing the Fed can't do anything about, but is at its most risk. Through our fiscal recklessness, we are causing inflation. We put over $20 trillion in the economy during COVID, and it's almost a year of GDP. And we expected no consequences, no inflation out of that. Nobody could put that kind of capital into their economy and not expect inflation. So what the Fed, Chair Powell should say, or the first question and second and third question out of every reporter's mouth at the next Fed meeting on February 1 and press conference should be, so why don't you tell the federal government and Congress that the biggest problem you face is fiscal and reckless deficit spending, because that's your biggest cause of inflation? But they won't do it. They're all too political. But that's the currency. You're right on. And the rest of the world's out there sitting going, what in the world do we do? And where do we put cash to work? Where do we place it? Do we put it in equipment? Do we put it in new plants and facilities? What do we do? So you're asking the exact right question, Jim.
Casey, I just love it as we're a global company with this map, in Canada, because I know we have so many Canadians listening on. What would your advice, with the way we changed the North American, trade agreements, we changed it. We had COVID blocking things off for a while. And now it seems like at least we're open for business. How is this working with the currency? Because I looked at Canada and Mexico, they weren't as affected too much. So what do you see the opportunity, kind of say Canada and Mexico, primarily in Canada with the US?
So Canada, it's the commodities, and we know the commodity prices are in short supply and going up, particularly rare earth minerals, things like lithium, all that stuff. So Canada, pay attention on your commodities and price them right. Don't price them cheap. The other thing is maybe you should buy a couple more railroads down here. They're good investments. Canadian Pacific bought Kansas City Southern and connected all the way down to Mexico. It's the first North American railroad. I think infrastructure, I think Canada is going to be very important in helping us in North America with our rebuild our supply chain, because it's going to be more north-south rather than west coast to east. So I think commodities, I think rare earth minerals, I think infrastructure. They don't have the population growth to build a lot of office buildings and whatnot, but they're a very industrialized economy that we need. Agriculture, commodities, rare earth minerals, potash to grow our gardens and our agriculture, all of that stuff. And now they can move all of that very well down using the railroads. I think Canadian National will be forced with the Canadian Pacific merger with Kansas City Southern to look at a U.S. rail merger like CSX or Norfolk Southern. They need that. So that's the play I see on Canada's side. On the Mexico side, it's a manufacturing powerhouse. They don't have the same kind of EPA problems that we have. They can put up a refinery. They can put up a new industrial plant or manufacturing, and they have the workforce. Their wage rate is about 20% less than in Asia. And so and it's skilled. And so I'm very bullish on Mexico logistics, the cross-border, and now with the railroad connections and all of those parts. Think of all the auto component parts that are made in Mexico, whether it's a BMW or a Japanese brand or American brand. We make many of the components and move them into the U.S. for assembly. So I think Mexico is going to be an increasingly growing manufacturing industrial power. And the place for us in the United States then is how do we add value, whether it's through assembly or adding value in the manufacturing process. But raw materials is Canada, the manufacturing component is Mexico, the infrastructure and logistics is all north-south. It's connecting in between. And without Mexico and Mexico's ports and Canada, all connected from Port Rupert and Vancouver all the way down into the Great Lakes, we don't do very well. So we're a French term if we don't appreciate the relationship with Mexico and Canada.
Casey, this is great because I know we had discussions about supply chain, right, through COVID. Supply chain, we saw the vulnerability, right, at our ports, let's say from east-west. Now it's north-south. So are we out of our supply chain issue, or is it that work in progress? Where are we at with supply chain?
No, great question. I was going to put some in there, but, I've talked about it so much. But, I talk about this thing called the Golden Triangle. And I defined this years ago at Colliers, where I looked at where all the site selection and all the manufacturing. Just look at this map right here and look at where all this is occurring. And it's really a triangle from the Great Lakes, in Michigan and in the upper Midwest, all the way down to Texas, and then all the way over through the Southeast. And what we have rail, we have ports, we have interstate, we have affordability, we have fiscally strong governments, we have all of those things. And about 80% of all of our new manufacturing announcements, our site selection expansions, are all in that triangle region. And guess what else is in that region? That's where 5 of our 6 railroads all move through there, except for Union Pacific, which primarily hugs the West Coast, but they do come east. But you look at Burlington Northern, Santa Fe, creating the T, the one horizontal, and everything else, Canadian Pacific, Kansas City Southern, Canadian National, CSX, Norfolk Southern, all the key railroads, they all move north-south and they connect us in that region. So that's where our supply chain is being made. And if you look at where Amazon or a Walmart or FedEx or any of the major retailers, where they're building their e-commerce warehouses, they're all in that Golden Triangle. They're very little on the West Coast because they know they need to connect to that supply chain. I'll give you kind of an odd example that I'm very bullish on. Is in Little Rock, Arkansas. So who would think, what about Little Rock, Arkansas? What the heck goes on in Little Rock, Arkansas? I think they have like a Razorback team. They think they play, sports and win national championships in baseball, and they growl at the University of Alabama in football season in the SEC. But here's what they've got. They have this thing called the Arkansas River. And in Little Rock, Arkansas, it is a major inland waterway that connects all the way down into the Gulf and the Port of Mobile. And companies have realized that. And so Tractor Supply picked it as their place to put all of their heavy equipment supply chain as they move it up and down the river. And since they're at the bottom of Mississippi, it generally stays afloat pretty good. And then Nucor Steel said, we're going to put our most modern steel manufacturing plant there. So when people think, what's going on? And you look across the river over at Memphis, that's Blue Oval City, Ford's Blue Oval City, which will be the largest manufacturing ever by Ford and for all their EVs. So they hug this infrastructure, whether it's inland waterways that can move things up and down the river from the port, whether it's connecting to ports like Mobile. Port of Mobile will surpass the Port of Charleston within probably 3 years, no more than 5. Port Freeport, south of Houston. The Houston port doesn't want all these container ships clogging up everything that's moving energy and chemicals. So Port Freeport is stepping in, and they will become to Dallas what the Port of Savannah became to Atlanta. So it's an amazing story when you start and ask 3 basic questions. When I'm in a city somewhere in the United States and I do any kind of manufacturing or I want to grow, what is the port that I connect to? And then how do I connect? What railroad? What are my physical means of ground connection? And if you have those, a port connection and a rail connection inland or a waterway, you will be seeing lots of economic development, onshoring, more reshoring of manufacturing here.
You know, Casey, that's why I always love catching up with you, always asking the questions that I have as we're building out, you know, EXP commercial and where can we add value. And it is when we were all there talking about the malls, right? The D malls, the malls, repositioning malls. Now it's in the office space. But the federal government, right, you saw, is asking everyone to come back to the office space. Now, from the no office space to what we see, the virtual remote working that we do at EXP, why is it, do you think, everyone's being kind of now shoved back into office?
So a lot of those companies have a vested interest in it. So you look at what Amazon did and the buildings they were building and the leases they were signing, you know, Amazon HQ2 and going to New York and those big leases. They have a vested interest in seeing that space is actually utilized, but the workforce is prevailing. They're saying no way. Now we'll come back part-time. We might come back in a couple of days a week, or we might come in for, you know, monthly, you know, or quarterly type team meetings. And that's why when you look at the U-Haul report, where this workforce is going is places that have good airports. And so you got to have good airport connectivity. It used to be, you know, you'd smile if you had Southwest. Now you frown. They've got a major overhaul to do, but if you got a Delta or United or others, they're doing a pretty good job. So a lot of these companies have a vested interest. Think of all the banks that have their name on a building and they financed it and whatnot. And you look at the banks and their earnings that are coming out and their real estate distress problems. There's a good report that's just out, TREP, T-R-E-P-P, does probably the most primary monitoring of the securitization and permanent real estate market. And they put out a year-end report every year. And they look at what's kind of going on. And they're the most down I've ever seen on the office assets. The other thing is it's not just them. Urban Land Institute. So I'd recommend you go online, Google CMBS Year-End Review 2022 by TREP. It is a phenomenal review. They'll collect your information. They'll send it to you free, but it's a great review. Anne-Marie DeCola is one of the chief executives. A good friend of mine, Tom Fink, who is there and helped me through the nightmare of the Fed when CMBS shut down. They just do incredible work. It's not made up stuff. The second one is Urban Land Institute. They do an annual emerging trends report. In their 2023 report that captured everything from 22, they had a couple of interesting observations. And one of those observations is the number one problem by every ULI member that they cited was there's a massive disconnect between buy price and sell price. And so you still have sellers saying my property's worth a lot at a 4 cap rate or a 5 cap rate. And the buyers are saying, you're crazy. It's like the Dutch tulip crisis, hundreds of years ago. That tulip isn't worth nothing. I'm not going to pay for it. And so that's number one big disconnect. The other thing they said is that the biggest problem is in office and retail. And for the first time ever in the whole ULI Emerging Trend Series, and I was with the first one at Legacy Equitable Real Estate over 25 years ago, they moved hotel as a desired asset class for investment above office and retail into a number 3 ranking behind industrial and multifamily. Never happened. So go back to that Boo Leisure comment that I gave you. They're recognizing that on the hotel side, this is a very different time. Hotel is going to perform just like it did during COVID. All the banks panicked in the first year of COVID. They bundled all their hotel loans and they sold them to private equity at 40 to 60% discounts. That was a big mistake. And those assets have performed very well. So I think the first thing is the entities that are pushing the people back to work, they have a vested interest, they own or finance those assets. Number 2, they're finding that the workforce has more to say than they do. And the third thing, the studies that are coming out are showing that the workforce is more efficient working remote, part or full time. And I get calls probably like you, Jim, 11, 12, 1 o'clock in the morning, and they start at 5 o'clock in the morning. I'm working, 70, 80 hours a week, more than I ever did at any point in my career when I went to the office all the time. And so I think when that workforce can do more and be flexible and use technology, we just don't need that office asset anymore. And going back to this graphic, I'll give you an analogy that's going to parallel this. Start thinking about gas stations and convenience stores. When you have this technology and you look at the numbers in this Argonne report behind the number of EVs and EV vehicles that are being manufactured and what will be in place by 2030, if we don't need to stop at a gas station anymore and go in and get a drink at a convenience store, I think we're going to see incredible distress in convenience store properties and gas stations, because we recharge wherever, at a grocery store, at home, at the office. We're not doing it at a service station. So what happens to those assets? What happens to that land? That's a great puzzle for EXP to help us figure out. We'll put in, the convenience store, but I think we're going to see tens of thousands of convenience stores that are going to become economically obsolete. What do we do with that real estate?
Casey, it's so interesting the time we live in since COVID, and now with the interest rate and possible recession. Yeah, I'm with you. I don't see how we get the soft landing, but it is so unusual. But today, one of the questions from one of our audience members was about the Wall Street Journal, how they were saying the interest rates rise and how it's affecting, insurance. And when, as you were saying, there was a price differential, and maybe there's not enough pain or they are holding on. When do you think that landlords are going to start unloading some real estate property where they're going to almost be realistic, whether it's a complete washout, sell it all, or saving certain assets, getting rid of some for tax write-offs? What do you see kind of going on with the disconnect as the interest rates are rising?
No, really, really good inquiry there. So think of 3 buckets. We've got the banks on the debt, the construction loans, the small business loans. Then we've got the CMBS market, which is our permanent loans. And then we have our institutional life insurance money and the interest rates. So think about, let's go in reverse this time. Let's look at the life companies and insurance money. Where does their capital come from, and how dependent are they on Fed rate hikes? Well, right now they're not at all, because they raise their capital through selling annuities and life insurance product. They sold all of that last year, in the last 2 years, at rates where they need maybe 4% on that money. And so for the year going forward, they can deploy it, but would you deploy that capital at 4% numbers when you could get higher 5, 6, or 7, like the CMBS in the bank market? That's going to be an interesting question. I think it'll be answered. Anybody in your audience that's going to the MBA annual CREF conference in San Diego, that'll be a really hot topic that a lot will be defined, because the life companies all come out with their new allocations of capital the first of the year. They like to deploy it early in the first 5 to 6 months of the year so they can go play golf all summer and not be stressed at the end of the year and make sure their bonuses are put away. So it's going to be interesting to hear how they're going to deploy that capital. A number of them I'm hearing say, we're going to go slower this year. We want to see what the Fed's going to do, because we're not going to, just because we raise capital at 4% numbers, we may not deploy it at 5% numbers. We may need to deploy that more, because when we go resell new insurance and annuity policies, that cost of capital will become more expensive. And that's because of the Fed. So now let's look at the CMBS market. How in the world do you underwrite and hedge a CMBS loan right now when you don't know what the Fed's going to do? It's impossible. You got to accumulate these loans. You got to hedge them. You got to have an effective hedge strategy before you then can structure the securitization and place it and close it out. I went through this in the 98, 99 hedge fund crisis and the Russian ruble default, and everything was hedged off the Russian ruble. And when that went, nobody knew. We had the big hedge fund, blow up. So the CMBS market, The numbers I think for last year were in the $70 billion range. And they're talking about that number could contract into the 40 to 50 billion, half the capital available. And what they're offering is going to be more like 50 to 60% LTVs. Forget these 75 and 80% deals that they used to do. The debt service coverage requirements are going to be tighter. So for someone that's in a non-recourse, single purpose entity, LLC structure, what's the skin in the game to stay there when it's that far out of whack? And so I think you're going to see the maturity defaults. And we're already seeing it from TREP and others. These maturity defaults, as these loans are hitting maturity, they can't refinance. They have no place to go. So now you get in with a special servicer, that guy that's kind of like a secret entity in the Vatican that you don't know what they do, and they're trying to send out different signals of smoke, but the wind's blowing so much you can't read what's coming out of the chimney. We don't know what they're going to do. We know we've gone through this before, where the special servicer holds all the keys, and they've got a fiduciary duty to each tranche holder, the A, B, and the A and B bond holder. And so while they would like to wipe out the B and just get the asset and take care of the A, they can't do that. It's not legally that easy. So the permanent market, which is supposed to be there in CMBS to help offload these construction loans when they're completed from the banks. Now let's look at the banks. Banks did a terrible job monitoring their construction loans the last 2 or 3 years. They just thought everything was going to be fine, free money, quantitative easing to infinity and beyond. And what they're finding now is they didn't pay attention to refi risk. What if the cap rate's 200 basis points higher? What if there is no permanent capital? Can we keep it on our balance sheet when the Fed is saying, nope, you got to go reappraise it, you got to re-underwrite it, and you're looking at 25 to 40% declines in value? Go execute your personal guarantee against that borrower, that developer, that construction lender, and squeeze them out. So what the banks learned, and this goes back to a study I participated in when I was at the Fed 2005 to 10, that 1/3 of the loss in a loss given default situation in a loan, particularly in banks, in construction loans, is in them creating an internal workout department and trying to take control of the asset and work it out. 1/3 of the loss. So if they cut that out, they have a lot more room to take a lower price. And that's what they did during COVID with the hotels. They just said, we're not going to set up a hotel workout department. We think they're all going to go away, which didn't happen. So they bundled these loans. They sold them at 40 to 60% off to private equity, and private equity made a lot of money. The banks are going to be very efficient. They're just going to bundle. When they see office building loans, or they see, convenience store or some other, retail or, big box building up, they're not going to create a workout department. You're not going to be able to go find it and negotiate and buy it out. They're going to put a grab bag. They're going to put 50 to 100 loans in. They're going to send them to private equity. So for like you and EXP, helping your audience and clientele figure out who are those entities? Who is that private equity? Because they're the ones that are going to need the help to say, okay, I got this bag. Now I need to sort it out. I'm going to dump it out. Tell me what to keep I can make money out of, and what do I just get rid of and take a loss, like milk at the grocery store. So those are the 3 capital stacks, and all 3 are in trouble.
I love that you bring this up, Casey. By being around, we get better prepared. We just don't know what's going to break. But now, remember, we were talking now mark to market. Since you are an MAI also, have you seen increases for people looking at portfolio and even single assets being reappraised mark to market, with the adjustment of lease rates and obviously building prices, with the risk of the interest rates, within 6 months, right? Doubling. It is kind of scary, and I don't think anyone could truly prepare. So what are you seeing from a appraisal, a mark to market now, as they are working, and we are already positioning with some of the largest servicers, right? We were positioning ourselves for this, but what are you seeing from the MAI Institute and other appraisal institutes? Have they been getting requests to do more mark to market now?
So I'm going to get in trouble. So I get burned in effigy at the Appraisal Institute in Chicago about every 6 months for something I said. I'm a multi-generation MAI. My grandfather was one of the first 100 coming out of the Great Depression. My father was one of the first 1,000 going through all of the nightmares coming out of World War II. I got mine under 10,000. The appraisal industry is way behind. And the leader of that is the Appraisal Foundation. This is the entity that was created under FIREA to be on top of this. And all they're focused on is DEI issues. They got a new thing called PAGE, the Professional Applications for Real Estate Appraisal, that could replace USPAP. And I sat on their board of directors last year, and I resigned because of things that I saw going on or in action. So they're focused all the way over here. And I'm not to say that Korea and DEI is an important issue, but right now we got to get the fundamentals. It's kind of like Maslow's hierarchy of needs. I need to get my house in order. I need to get a roof on it. Then I can go up and deal with these other issues. And they're way behind. The education is behind. That's why I like the CCIM Institute so much, and I'm so involved, is that their education is incredibly robust. They haven't diluted it. They haven't diluted the designation. It is hard as nails to get a CCIM designation, and the education is incredibly rigorous, and they do a lot in the valuation. The appraisers, I have yet to see an appraisal, and I do a lot of review work, come in that does a band of investment to test their cap rate. The appraisers today have been using the averaging technique. It's not a valid approach to value. There's only three. There's the sales comparison, the cost approach, and the income. There's not an averaging technique. They'll just take all the comps, average them together, and say, there's your value. And they don't test the cap rate looking at a band of investment. And if you did, you'd see the cap rate can't be in the 5% range anymore. It's got to be north of 7. There's a lack of comparables, true comparables. So if you're doing a self-storage or you're doing an office building, there's a shortage of true sales. And the ones you're seeing, look at downtown Atlanta, look at downtown St. Louis, where high-rise office buildings have recently transacted for essentially zero. And they're going to give them or donate them away to try to do some sort of a affordable housing project. These urban assets and what they're worth, what is an office lease today where the tenant can no longer get a ratio of 1 employee per 180 square feet. It's got to go back to 300 or 400 square feet, or it just doesn't need that much space. So in all these lease renewals, what we're seeing is the entity may stay in the building, but they cut the space in half. And they do more of an open space work remote model. So these things that the appraiser should be able to measure, it's harder, and it means they can't do it fast and cheap. You can't do that kind of appraisal in 3 to 4 days at $5,000. It's, if it's me, it's probably 20 grand, and it's probably 3 weeks because I'll do it exactly right and get data. They're not looking at things like the Castle system and what's happening with the back to work barometer. And you can pay a subscription fee, and Castle will tell you by market. They'll get you very detailed by the MSA rather than just, the overall markets. On the industrial, we've seen industrial, while it's still performing, we're seeing big e-commerce retailers hitting the pause button. And what they're hearing are things like from their merchant developers, they can't get a construction loan. So how do they build them their next new e-commerce building? And so some retail companies are saying, maybe we ought to entertain the idea instead of stock buybacks. Maybe we should get into the ownership side, and maybe we be the self-funding construction lender for the merchant developer. We are going to see massive changes in the metrics that are happening are changing pretty radically. For example, in multifamily, suburban is renting in many cases better than urban, both on absolute rent per square foot and occupancy. I don't see an appraiser distinguishing between those urban and the suburban markets or the secondary markets, or talking about U-Haul reports, or talking about the ULI emerging trends report, which is rich full of data that can help us understand where's the opportunity, where's the risk, and then where do I come in on my value. So I'm very disappointed, and the banks are terrible because the banks hire their appraisers. They have their fee panel. They want them all cheap, and they don't want them to ever really tell them that the value changed a lot. So just like when the market's going up, they say, we don't believe you. I don't care that house that has 3 backup contracts. I don't care that you're telling me it's worth $500 million. It last sold for $300,000. There's no way it could be worth $500,000. On the downside of the market, it's the same thing. If the appraiser comes in and says that office building that used to sell at $250 to $300 a square foot isn't even worth $100, that appraiser's fired, they're off their fee panel, and they don't get to do another appraisal. So the appraisers are kind of, slow to react. They're on that teeter-totter, trying to just go easily. And so where I do mine, I do most of mine in litigation work. I go to court and I blow them out of the water on what they didn't know, what they should have known, and they didn't know in their valuation analysis. So cap rates have gone up. Office is terrible. Retail apocalypse is still with us in big box. The saying I use today is that remote work will be to office what e-commerce was to big box retail. And I don't see the appraisers really digging in. Look at the land and the housing right now. I've reviewed 3 recent subdivision deals. One was for one of these for rent subdivision entities, a real big one. And so they're out of business. Private equity pulled out. And so the bank line that was funding them said, we need to know what the residual assets are worth. And they didn't know how to do a subdivision analysis. They were still assuming the same absorption that was occurring 6-12 months ago that today has builders with 60% cancellation rates. And so if you layer that in like 2009, those same type metrics, you find the assets worth somewhere between 25 and 50% on the dollar that you lent on. And that's not happening. We're not getting the true discovery. And it's shameful. The bank regulators aren't holding the bank's feet to the fire. They didn't hold their feet to the fire on the construction loan monitoring. They had cost overruns. And in a bank construction loan, you have a cost overrun and you have a 70, let's say a 70-30 loan to value from 2 years ago. If there's a cost overrun, the developer is supposed to pay the 70% of the cost overrun, the bank 30%. Guess who was funding 100%, not even getting an appraisal? The bank. It's a mess. And we're going to see a lot of problems. So unfortunately, I don't think we see the transparency. By the time we do, and things are starting to turn, and maybe the Fed pausing, then the appraisers are going to get religion, the banks are going to get religion, and they're going to go overboard just like the Fed did. So I tell you, if you've got a valuation problem, call EXP. If you can't find somebody, Jim, I will help you find someone that really knows how to do the analysis and connect the dots. But especially if you got someone that's looking at new equity capital, you got private equity coming in, and they wonder whether the value's in that grab bag that the banks want to sell them. They better do their homework, because I think things could be a real surprise.
Casey, no, I love this because, friends around the world, global markets, right? We want to know forward thinking, not sometime back, but who is kind of a little progressive on technology, the changes, right? There are paradigm shifts within commercial right now across many industries. And this does seem like a way to bridge the gap is going through public-private partnership. So I would ask that one, but also AI, how is that going to affect us? I mean, I'm messing around with chat GPT, all these other ways of using AI now. But can you answer the public-private partnership to almost bridge the gap? And then the AI kind of phenomenon that's coming in everyone's industry.
No, I think you're spot on. The public-private partnership, it's a new model. It's going to be, it's deja vu. It's going back to an old new model, deploying it differently. But it's how do you bridge and bring that capital together to move things forward? I think we're going to see it tremendous in things like infrastructure, factories. Like how does a big automobile plant get something done when the bank won't do it, or they have real estate concentrations and can't do it. So I think those partnerships are going to become very valuable. And I think, you look at ones, you look out of, the Middle East, you look out of Vietnam, you look out of South Korea, Asia, you look at Canada with the commodities and the money that they're raking in, where do they put it to work? So I think exactly those partnerships are going to be important. And as far as AI, look at what AI did to the residential real estate industry, turned it upside down. I mean, honestly, from the platforms, whether what you have or, even like what Zillow did, who the heck needs an appraisal when you've got, these platforms like a Zillow that can do a better job determining your house value. And I think we're going to see that on commercial real estate, because this shift is, we used to say that commercial real estate always had to be valued by an individual because each lease was different, each building was different. We now have the technology where we can grab all that. It's scraping it out of earnings reports. It's taking them out of 10Qs and 10Ks. It's taking, you can go on. When I do court work, it's amazing what I can find in a 10Q or 10K filing about leases and rates and what they're doing that I don't need to go verify. I don't need the leases myself. And so I can get 90% close to that answer. And then, things like you can automate, what's the cap rate? How can I do a band of investment? What can I test it against going into data to look at, true comparables? I don't have to do the averaging technique. I can get rid of all the clutter and narrow in on truly the 2 or 3 comparables rather than transactions. I think it's going to be huge. I think my industry, I'm 60. I hope I can retire by 70. I'm good at foreseeing it, but I'm bad. My timing is always bad on the investing. So, but I'm hoping, I can retire at 70. I'm going to take up high risk activity so I don't have expensive healthcare costs into my 80s. So I'm going to take up helicopter skiing and avalanche hiking and whatnot. And the reason is I see my world as a commercial appraiser being completely taken over by AI. The information, what I look at and try to keep up in reading, imagine if we can link together the TREP data and the Moody's data and all of these things out of these public companies and put them all together into the model. We can do all that. It's just getting the permissions and the licenses to put it all together. And you guys will do that. I think you guys will be the ones that do it.
Well, Casey, thank you for being here. And yes, kind of going forward, that's what we're looking at exploring as technology's moving and very forward thinking, and we learn a lot from our realty brothers and sisters and other companies. So it's always learning, always listening, always trying to test it out, see what happens. But one final word to everyone there. Let's go on an optimistic. What can you say on a positive note to start this year for 2023?
So whenever there's challenging times, there's just as much opportunity as there is risk. And that's what you have to look at. So look at those markets, like look at the UL reports, read things like the ULI Emerging Trends Report, pay attention to the metrics that are changing and why they're changing. Understand that, don't buy into this thing that the Fed's going to cut rates by the end of the year and it's all going to be okay. It's not. Make a strategy for how you can do it. So I think look at hotel, Boo Leisure, tremendous opportunity. Look at things like what's going to happen as we roll out more EV cars and what do we do with C-stores. Be thinking about what's the adaptive reuse. Adaptive reuse is a tremendous opportunity that we're seeing more and more. I just, I still do these. I have the largest database in the country and we look at, different things that happen, whether it's a motel to affordable housing or a high-rise building in the inner city to affordable housing, hospital redos. Look at what's happening at ports. Pay attention to the ports. We'll be glad. Maybe we do a ports and logistics one, Jim. But the ports, like you look at Savannah, you look at Charleston, you look at Port Everglades in Florida, Mobile in Alabama, Freeport in Houston. These things are booming and have economic growth, and companies are reshoring to be close to that port to then know that it can get into the rail. Look at the rail mergers. Canadian Pacific and Kansas City Southern wasn't an accident, and it's part of remaking our supply chain north-south. Look at where any of these new technologies, things like EV battery plants, where are they going and why are they going there? And when you unlock those two questions, you see the opportunity. If you just lament, wow, this big box store just closed, Macy closed some more stores, you're missing the opportunity. What am I going to do with that store? What could I do with that property? So that's why I say in these challenging times, that's where we, separate, the wheat from the chaff. And there's always wheat in that crop out there. So you get the chaff out of the way and go get the wheat.
Casey, thank you so much again for being here for our national meeting kickoff to 2023 Fireside Chat, sharing your wisdom, experience, knowledge, and we'll kind of go there on a quarterly basis to make sure gauging where we're at and making the pivots and adjustments we can. So Casey, thank you again for being here with eXp's national meeting. And we look forward to seeing you around in the metaverse, but also in live meetings. Thank you, Casey.
And in a Delta Crown room at an airport.
That's it.
Take
Safe
care.
travels.
Happy New Year.
Happy New Year.